There we go. Now I'm going to share my screen. Now I'm going to start the presentation. Oh, this is right in the way. I'm going to stop sharing my screen, start the presentation, and do it the right way. Sorry, guys. Rookie here, right? Brand new. Never done this before. Slideshow. I'm doing this backwards because my monitors got reversed. So I'm clicking the wrong places and moving stuff around. I'm so sorry. Do you guys see my DFL screen now?
Yes.
Yes. Okay, great. All right. So debt-free life. So hi, my name is Scott Forehand. Today is August the 31st. The penultimate day before National Insurance Awareness Month begins. And we're also excited about that. I know that's exactly why you're tuning in today, because you wanted to hear all about National Insurance Awareness Month. So let's keep going. So the idea here, this is debt-free life. So debt-free life is a play on words, and this is Symmetry's proprietary infinite banking system. So debt-free life uses two separate financial instruments. One is called an infinite bank or private bank, and the other is called a debt snowball. Not the debt snowball that Dave Ramsey talks about, which is an incorrect phrasing of what he's talking about. But this is a true debt snowball, not a debt stack, which is what Dave talks about. So let's keep going. So debt-free life. So with debt-free life, we're primarily interested in doing two things. Number one, we're interested in making sure you have a great retirement, answering that first question on your screen. And the way we do that is by eliminating your debt faster than you ever thought possible. If we can eliminate your debt quickly, that means we can have you put you in a situation where you're saving more money for retirement, or you're getting your retirement nest egg built bigger, faster. And what that really means is we're allowing the compounding interest effect of retirement accounts, if you set them up correctly, to really have more time to compound. And that's, taking advantage of what Einstein said, eighth wonder of the world, most powerful thing, the effect of compounded interest. So let's keep going here. So if we're looking at most Americans, then you are probably looking at what you see in front of you, which is how your debt is set up to keep you from saving the amount of money that you should be saving for retirement. The average American spends 23 cents of every dollar on just living expenses. That's power, food, gas, maybe a mortgage payment, the principal portion of a mortgage payment, putting food on the table, paying for your children's soccer class or after school programs, whatever. It's that stuff that we use, is the money that we use to live on. Unfortunately, and this is not the way that that our founding fathers had this planned, we also spend about 40 cents of every dollar on taxes. That's when they first started here 200 plus years ago. It was I'm not really sure the number, but I think it was below 10%, and we're at 40% now. In addition to that, this is the debt part that Americans are unfortunately saddled with. Last time I looked at it, we were $34 trillion in debt, on a fast track to 40 trillion, which is not a number that our country's GDP can support. So we have a lot of interest, and that's because the entities that are out there that offer to lend us money make it very easy to get into debt, but they do not want you getting out of debt, because that's their business model. That's how they make money. All right. So if we can change the way you spend money, I didn't say make more money for you. I just said change the way you make money, which is also going to be changing the way you save money. Then you're going to be a lot better off. So the average American makes about $2 million in their lifetime. That's pretty good. The average American, unfortunately, as on that last slide, only saves about 3% of their income for retirement. So all of a sudden, you get closer to retirement and closer to retirement, and then you flip the switch. And that money that you were making, 60, 80, 100, $200,000 a year, you're not making anymore. And now you're reliant on whatever pension programs you have set up or whatever retirement programs you have set up, or maybe Social Security. And you're able to use that 3% that you've been setting aside to live on. How long is 3% going to last when you're used to using and spending 100% or 97%? Not very long. And that's the problem that most Americans have. The average American only has about $60,000 saved for retirement at the time of retirement. And that doesn't go very far. It doesn't last very long, especially when you're making $50,000, $100,000, $150,000 a year. So the problem that we see is spend too much money on taxes. We spend too much money on interest. We don't save enough money for retirement. And what's left over, that 23%, it's really robbing Peter to pay Paul in many cases, especially people playing that shell game with credit cards, the 0% for here, moving, transitioning over, and all that kind of stuff, the crazy stuff that people do. And when you go talk to an expert, a professional, a debt management professional, they're going to throw out some ideas. And the ideas that you see are those on your screen right now, those bullets. And I'm going to tell you, the only one of those bullets that works with regular consistency is going to be the debt snowball. And that's only if it's a real debt snowball. So just taking these one at a time, how hard, if you could work harder, wouldn't you already be doing that? And if the answer is to go work harder, how long can you do that? If you could spend less, why wouldn't you? Wouldn't you already be doing that? If you could save more, why wouldn't you? You know, the whole idea of refinancing, all that means is you're taking some debts and turning it into another debt. Maybe you're saving a couple of points on interest, but it's not really a logical financial solution, especially not in this day. You're not going to refinance anything at a lower rate these days. And that final one, consolidate. You know, all that is, what's consolidation? That's taking a bunch of smaller manageable debts and putting them into one pile that's way less manageable. It doesn't make any sense. It's actually making it harder for you to get out of debt. All right. So that's not what we do here. And that's not what we're going to show you. We're going to show you a better way. The better way is to get you from the left side of your screen to the right side of your screen. I want to change it so that you're not saving 3% of your income for retirement, but you're saving 15%. And I'm not, notice I didn't say spend less. I didn't say save more. I didn't say go get another job. I didn't say go eat tuna fish and ramen, which I love both, by the way. I didn't say any of that. All what I'm saying is we need to change the way you spend money and the way you save money. Okay. And we are not going to tell you to go say, hey, Mr. Creditor, if I owe you $3,000, if I give you $2,000, can we call it even? That's debt negotiation. We're not going to do that either. We're not going to destroy your credit. As a matter of fact, as a byproduct of these programs, what we see is usually about 2 years after people start, the credit score goes through the roof. Anybody ever needed to borrow money? Ever tried to go borrow money from a bank when you've had some credit issues? They don't want to lend it to you. Anybody ever not needed money and have a really good credit score and you've got plenty of money, you don't need to borrow anything? They fall all over themselves trying to lend you money. Okay, so the idea is we want to put you in that latter position because really, at the end of the day, you won't need to borrow money anymore if you're using this program the right way. So how are we going to do it? All those bullet points that you see there. We're going to reduce your interest rate. We're going to eliminate all your debts as quickly as possible. I know there's at least one client on the screen right now that I can see. We're going to eliminate all his debt in about 3.5 years. We're going to improve your cash flow. In this game, cash flow is king. It's not about how much do you make, it's about how much do you keep. And that how much you keep is definitely influenced by how much your cash is flowing on a monthly basis. And then finally, we're going to allow you to retire with a tax favored income. And in my opinion, the most tax favored of all incomes is a tax exempt income. And we're going to try to get you to at least some portion of what we're able to retire with is going to be tax exempt. So you've heard of these other programs that are out there. There's a lot of them. And there's a lot of different companies that are pitching different things. Some of them are using home equity line of credit models. That's also called the Australian model. Obviously, these days you can see that failing. I had one of our clients come to us. She actually did the Australian model on her mortgage, turned her entire first mortgage, which was a fixed rate mortgage, by the way, into a home equity line of credit, put the entire thing into the HELOC, got it down to a really super low rate, down to like 2.2%, 2.3%. Didn't realize that the number that she was paying was interest only, and didn't realize that it was an adjustable rate loan. And that loan just adjusted to 8.7%. And now she can't even make enough money. She can't even pay enough just to pay the interest component only of her home equity line of credit. And so now we're scrambling to get her all fixed. But that's the problem with some of those other issues out there. And then there's some of them out there that talk about using life insurance, which is what we do. But the problem with that a lot of them, especially if you're using the universal life programs, is that there's too many unknowns. And if there's an emergency, you're not prepared for it. So that's what we do. Our 80-20 rule is that we provide a solution that's going to hide about 20% of the money in your program that you can use for an emergency anytime you want, for whatever you want, whenever you really need to. But we also want to make it painful so that if you really need to get to that money, it's a real emergency. It's not an I need a new jet ski emergency. It's my brother just lost his job. My sister-in-law lost her job. They've got 3 kids. Their house is getting ready to be foreclosed on unless they can come up with $50,000. That's the kind of emergency I'm talking about, a real family emergency. Okay. So when this is again, back to the investment piece. So when I look at retirement income streams, there's standard retirement income streams, 401s, 403s, TSPs, KEO, SEPFRs, all those kinds of programs. Those are tax deferred. There's a taxed retirement program. That's somebody who's putting money into a coffee can in the backyard, maybe money into their mattress, saving money in a savings account with a very low return. And then there's tax exempt or tax free. Guess what? This is the tax exempt or tax free program. As long as you play the game right, play by the rules. All right. So please don't have any illusions about what this is. Yes, it's life insurance. Yes, we're using life insurance and some of the benefits of life insurance. But in the end, this is a financial program. It is a financial tool. And all financial tools work in a process: maximization, accumulation, distribution. Maximization. How can I get to the point where I'm putting the most amount of money into my program as frequently as I can? How quickly can I get to the point where I'm saving more for my retirement than I was ever before? That's the maximization phase. And in our case, if we're talking about debt, that's the debt elimination phase. We just eliminated our debt. That's what's going on. Accumulation. What is accumulation? That means we've reached that pinnacle. We've hit, we're not going to have a great increase in our income. We're not going to be able to throw more money at this with frequency. So what are we going to do? We're maximizing it. We're going to get it up to that level that we're spending the most amount of money for our retirement, and saving as much for retirement as we can. And then finally, distribution. What is that? Distribution is simply, how do I take the money and when and how long? So if you're looking at, here's a good example. If you're looking at using an IRA, 401k, 403, whatever, as a retirement vehicle, you have limitations on when you can touch that money. If you're looking at a Roth, again, you have limitations on when you can touch that money. So what does that mean? That means for me that our government, through regulation, is telling us when we can retire. Because if we can't retire without an income stream, we need to get to our retirement program, but they won't let us get to our retirement program without a penalty. They're really dictating to us about when we can retire. That's one of the things I don't like about those programs. And that's one of the things I love about this program. I can retire and start taking money from it when I want to. It doesn't matter my age. Okay. This is not a new program, folks. And by the way, I'm scratching my nose because I have allergies. Sorry. So what I'm looking at here is what you see on your screen right here. These are people that have done this in the past, and they're all big names. And you've heard of all these people. Warren Buffett does it to this day. But what's not on here is the early programs. Where did the early programs come from? 1904. It's the first one I can find. And that program was done by John Rockefeller. And that's why this is also called the Rockefeller method. It was designed not as a debt elimination tool. It was designed as a legacy creation tool or wealth building tool. And that's what we're doing with it also. So we're knocking out three birds with one stone. We're going to eliminate your debt. We're going to create a retirement, and we're going to create one heck of a legacy for your family. Okay. 1904. Other people that have done this for different reasons. J.C. Penney. J.C. Penney did it. Why? Because he had a business that was cyclical on an annual basis. And he noticed that every year in the wintertime, leading up to Christmas, it was super busy, made a lot of money. And then in the spring and summer, there wasn't a lot of money coming in. So he didn't want to fire his staff. He wanted to keep his staff, keep them employed, more importantly, keep their families fed. So he put money into his program and pulled it out when he needed to. And you'll be able to do the same thing. Okay. So all those bullets that you see on your screen, these are all real tools. These are all real solutions that can allow you to really create a personalized financial instrument that you use when you need to use it, when it makes sense for you to use, when there's a logic to it, and also a financial logic as well as an economical logic to it. That's up to you. How you use a program is up to you. Each one of these programs is different. They're all structured differently. They all work the same way, but their performance is going to be based on you, the individual. Whether you're putting $50 a month into the program or $5,000 a month into the program, they both work the same way. Okay. So where are we at? These are just some of our early adopters that we used. This is about 5 years ago that these people came on board with us. And those numbers that we see today, those numbers are light compared to what we traditionally have seen in the past. I'm looking at realistically, most of my clients have between $500 and $2 million worth of debt when we start these programs. So this is kind of the this is kind of light. Okay. All right. Before we go any further, you need to understand how you're spending money right this minute. So this is kind of an example of what you do. So if you go out and you make money, you get paid a paycheck. That money gets deposited into your checking account, right? That money goes into your bank. It doesn't matter who you bank for. They all work the same way. And that bank actually lends your money out every night at the federal funds rate or higher. The average dollar that you put into your bank account earns your bank 61 cents. How much of that money do they give you? Zero. So let me ask you this. If you had the opportunity to borrow money from somebody anytime you wanted at 0% interest and make as much money as you could, and then put it back and you don't have to pay them any of the money that you made, wouldn't you do it? That's how banks make money. That's called arbitrage. They borrow money from you at a 0% interest and lend it out every night. So in the end, what happens? In the end, you tell your bank, I need to pay my debt. And you go into your bill payer, you write a check, and that money gets transferred to your creditor, and your creditor receives your money. In this example, you traded exactly X number of dollars for X amount of reduced debt. Your trade is X for X. Your gain is 0. Now, you may have eliminated some downline interest, but that's not really a gain in the grand scheme of things. Your gain is 0. Your net wealth or net worth has changed 0. Okay? So what about if there's a better way? And there is. Of course, I'm biased because this is the program that I use, and this is a program my wife and I have used for a couple of years, and it's worked great for us, but I am biased. And here's how it works in the new way. So nothing changes with how much money you make. Nothing changes with the way you make money. You don't need to go out and get a new job. You don't need to become a Walmart greeter. Not that there's anything wrong with being a Walmart greeter. The same money that you make goes into your regular checking account. That doesn't change. But here's where it changes. What happens is, instead of us leaving the money in there for our bank to use over and over and over again and us not doing anything with it and trading X for X, we're actually going to make the money and make a pit stop with it. and we're going to send our money up into our life insurance account, which is a whole life insurance policy. So there's other companies out there that offer different programs. Like there's a program like this that's based on an indexed universal life and IUL. I'm not a proponent of those programs simply because an IUL, the return on an IUL is variable. You have no idea where it's going to be, and you can't really predict it. There's also usually there's some additional limitations about how long you have to have money in the program before you can gain access to it. Me personally, I like a program that if I need to get to my money today and I put it in yesterday, I can get to it. And that's one of the reasons why I use whole life for this. It's specific whole life, but it's not just basic whole life. What I mean by that, I mean, when you actually spend that money and goes up and you pay your life insurance premium, it actually gets split once it hits the carrier. It gets split 3 ways. It gets split into whole life, which is the base policy, term life, which is a rider, and PUA, paid up additions, which is also a rider. Now, this is really critical. If you had the IRS looking at you and looking at how much money you had and how much money you were making, and you were gaining some of that money from life insurance, the IRS would say, hey, look, all money derived from a life insurance policy is tax exempt. So whatever you're doing, we're not taxing it. And if you had a bank that you wanted to earn interest from, say all money that you're paying us is cash, and we're going to pay you a guaranteed interest rate and a dividend on that cash value, then that's the way you'd want that to work. Well, guess what? You get to have your cake and eat it here. The carrier looks at the money that you're spending on the program as cash growth. It's not all cash, but that's the way they look at it. The IRS looks at the money that you're spending on the program as life insurance. So none of it's taxable as long as you play by the rules. So in this case, just as a standard distribution model here, 21% of your whole life, of your premium that you're paying is going to pay the whole life part. 11% is going to pay for your term life rider. And 68% is going to pay for paid up additions, PUA. Why is that significant? Because the carrier looks at PUA as cash. And why is that important? It's because of what PUA actually is. It is an asset. Okay. In the banking terms, you've got different classifications of assets. They're broken down by tier. So a tier 4 asset would be a thing like a loan that you made to a 22-year-old dishwasher to go open their brand new $1 million restaurant. Will they do it? Some fool will. Will they get the loan? Maybe. What will happen? They'll probably fail. Very high risk loan, but it's still an asset. Well, what about gold? What about platinum? What about silver? Precious metals, are they solid investments? Absolutely they are. Can you tell me how much they're going to be worth tomorrow? Absolutely I can't. They're variable. So if I don't know the value of an asset, then how can I really bank on that asset as something to pad my bottom line? That's why banks buy these policies left and right. Bank-owned life insurance. There are companies out there called biatical settlement companies, and their sole purpose is to find people with life insurance policies of large size that may or may not have cash value, and they will buy them for pennies on the dollar, name themselves and ultimately the entity they sell that policy to as the beneficiary of that policy, waiting for whoever they bought it from to pass. Okay, so you probably heard advertisements on the radio. Hey, if you've got a life insurance policy worth $100,000 or more, don't sell it. Don't cancel it. Call us first. It might be worth money, and we'll pay you for it. Right? I'm not going to advertise for those companies that do that. I think that's predatory, but that's between them and their maker. So that's what those are. So who did they sell those policies to? They sell them to banks. They sell them to Fortune 500 companies. They sell them to major industrial components of our economy. Who are some of those players? Bank of America, Wells Fargo, PNC Bank, some smaller banks too. There's about 30 or 40 of them that I can't remember all of them. I just remember the biggest ones. Who else? Ford, Boeing, Heinz, GM. The point here is that all these companies look at life insurance as an asset. And when they add that asset to their bottom line and they try to say, we're borrowing $500,000 or $500 million, but we've got $1 million of life insurance over here that we're using to balance our books. So when they borrow that 500 billion or 500 million, and they've got $1 billion of life they've purchased and owned that has a permanent value, they're still 500 to the good. And they bought that stuff for pennies on the dollar. So if they're doing it, if they're using this as an asset to pad their books, if they're investing in it as heavily as they are, incidentally, the last time I looked, PNC Bank had $19.2 billion of bank-owned life insurance on their books. Okay, if they're doing it and they know about it, maybe they know what's going on. They're the banks, right? It's called a tier one asset. And why is it so valuable? Because it costs almost nothing to maintain. It has a permanent value that absolutely will pay out. Why? Because life insurance companies are the most stable companies on the planet. So in this example, when I move that money that I paid into my checking account that I earned, and then I move it into my private bank or my infinite bank, I have essentially sequestered my money forever. Because one of the rules of our program is you don't ever take your principal out. All you're ever touching is interest or a loan. Okay, so how do I use it? Let's say I want to make a car payment. And this is going to be really important. Let's say I owe $3,500 on my car. And I have the choice to put $3,500 directly on my car and pay my car off, or I can put $3,500 into my infinite bank first. In this example, we're going to go with the infinite bank route. So I put $3,500 in as part of my premium payment. I've got $3,500. It builds up. And then I want to pay off that car. What do? I take a loan. I take a carrier loan. Is there any doubt whether they're going to let you borrow essentially your own money? Of course they will. Of course, they've got no risk, right? Because they've already got your money. You've already paid for the life insurance. So you're just using that life insurance value, cash value of that life insurance as collateral to take the loan. And of course they will let you take the loan because they've got no risk. Now, what it does mean is that that's $3,500 that you took out that they can't invest anymore. So the return's going to be less. So they do have to charge you a fee. Okay. But because this is whole life and specifically participating whole life, they're paying me a fee as well. And this is that whole process of a bank can borrow money from you at 0%, lend it out at 1.6%, make 61 cents with your dollar and pay you nothing. That's called arbitrage. Yep, we're doing the same thing. We're borrowing money from our private bank. We're earning, in some cases, more interest than we're actually paying on the loan. And you can do that, and we can show you how, and earn arbitrage on our money and still pay our debt. So what happens? We just borrowed $3,500 from ourselves, from our private bank. The money got deposited as a carrier loan back into our regular checking account. And then we told our bank to go ahead and make that payment. And they sent that payment to my car company. All right. Let's see if you're following. Somebody wake up LaVon. Let's see if you're following. All right. Where's your money, LaVon?
Well, your money's still in your bank.
Yes, you got it. Right on, brother. Your money is still in your bank. Whose money did you use to pay off that car?
You use your own money.
You use the carrier's money. Your money is still sitting in your private bank.
Well, I mean, yeah, well, the right? Carrier's money.
So your money is still in that private bank. Your $3,500 is still there. I didn't take your $3,500. I took a loan against your $3,500. And I put that back into my regular Wells Fargo, Bank of America, whoever I bank with. And then I sent a check from my Wells Fargo bank and paid off that car. What's my gain here? How much did I gain? What's my net wealth now? My net wealth just went up the value of that car because I still have my $3,500. It's still sitting in my private bank, earning interest and a dividend for me every day for the rest of my life. And I also have the $3,500 of increased equity in that vehicle. my net wealth just went plus 3,500. So
Okay.
this is something that the wealthy have known about for a long time. This is part of the reasons why they do this. And this is something that is now becoming more and more available to the general public. And that's why I'm here to teach you guys about this. So let's go ahead and we'll stop this part of the presentation. And let's pause for some questions. Mr. Creighton, do you have any questions? Do you understand how these things work?
I do know how they worked. I got a story for everybody when you're ready to hear it.
Let's hear it. Let's hear Mark Creighton's story.
This is a true story, sad story, but it's not so sad. Oh, it is sad. So, what day are we on today? 31st.
It's
15
31st.
days.
Come on, man. It's the first day before National Insurance Awareness Month.
15 days ago, I lost my 54-year-old brother.
I'm so sorry.
My 50. Yeah, thank you. Short, unfortunate, brutal battle with cancer. We lost him. But about 5 years ago, I talked to him about this very concept. They have, I've got a niece and a nephew. Nephew's a little bit older. My niece just graduated high school last May. She's starting college, but she had decided, got intervened and decided to talk her into having a gap year so she wouldn't have to mess with everything that was going on with her dad. So she's going to a junior college right now because she had gotten a scholarship and didn't want to lose it. But she put off full college on hold. 4 or 5 years ago, my brother was interested in, we were just talking and I told him about this program that had existed. And I told him about it, and he was very concerned about eliminating some of the debts and freeing up some cash flow so they'd be able to send their daughter to college. She is like ridiculously talented. We're talking like Juilliard. Somebody once asked her, "What instrument do you play?" She answered, "Whichever one you want me to." She is unbelievable. But they've got the college thing over their head. Told them about this program. He put it in place. Okay, so I'm going to talk about the elephant in the room, and we are talking about a device that is called life insurance, and nobody wants to buy life insurance. Dave Ramsey is, pardon me, anybody who gets offended, he's an idiot because he doesn't tell the whole truth.
Yep.
There are some things he says that are good. Everybody should get rid of that. There are a million things he doesn't understand about permanent insurance. The kind of permanent insurance, the kind of whole life he's talking about is what used to get sold. It is not what Scott's talking about here. This is constructed in such a way that it provides immediate benefit, usable benefit for the clients, not something they have to wait 10 years to have. Even that is a great product, but that's a different story. Talk about life insurance. Everybody gets, well, what's the rate of return? What's the rate of return? What's the rate of return? The internal rate of return in a participating whole life policy from a mutual company is very boring. It is not the sexy part of the story. The real rates of return come in the form of when you pay down a 22% credit card from a 5% loan from the insurance company. What's your rate of return on that money? 22 minus 5, 17% on that debt. That's instant. That's additional cash flow. That's getting you to your retirement. Now, let's talk about the other thing. I don't care about the death benefit. This isn't about the death benefit. It's about the cash and what I can do with it. Guess what? My sister-in-law is very excited about the $675,000 death benefit check she's going to get. Are all her debts erased immediately if she so chooses? Yep. They were already ticked off. She's down to just like they were down to a couple left anyway. But now everything else is secure. My niece can go to college, almost the college of her choice. They are protected. So in and of itself, you don't have to talk about death benefit, and this is a great story because everybody's worried about retirement. And the problem is they don't have a retirement plan because they don't have money for a retirement plan because they're giving all their money away. You're going to show them how to keep their money. You're going to show them how to have that retirement picture, something that's actually within their grasp. And they're going to bite at this. And then at the end of it, oh, by the way, I don't have the numbers. In another call one day, I can tell you exactly what the rate of return my sister-in-law got from that policy. But I assure you, Wall Street cannot provide the rate of return that death benefit provided on their $500 a month premium.
Yep.
Couldn't even touch it.
Yep. Agreed. Yeah. It's unfortunate. And you're talking about, this is something in my history. So about 3 years ago, I did a talk. For those of you that are here at Symmetry, there's a guy named Mike Resma here. And I did a talk and a presentation with Mike Resma. And the focus of my talk is, where was Dave Ramsey wrong? So this is about 60 pages of data that I collected about all the stuff that Dave Ramsey said. And there's about 15 pages here about where he was hypocritical. So absolutely, Dave Ramsey, I love what he tries to do, at least on the surface, but I think really what he's trying to do is make a buck. And that's unfortunate. And a lot of the stuff that he says is inaccurate, incomplete, and he'll only say a half truth. And that's saying half truth is the same thing as saying a lie. So, so yeah. So thank you, Mark. I don't have anything against Dave Ramsey personally, but I do have something against people that intentionally say something that's incorrect, intentionally incorrect, and that's where my issue is. But thank you for that. I know that you and I have been talking about what's been going on with your brother, and again, I'm so sorry for your loss. And this has been a bad year for those of you that know Mark. This has been a bad year for Mark, lost 2 close family members, and yet he's still here, and he's still supporting us, and he still supports all of us agents, not just here at Symmetry, but everywhere, all the agents. And Mark, from my heart, I want to thank you. So
There's my pleasure.
Yep. So
by the way,
for sharing
going
that,
back to
go ahead.
Scott said a key thing early on, and hope you all got it and took note of it. So in so many presentations, and financial people want to tell you they have all the answers, and all the answers are based on, if the stars aligned, this is what you're going to have. IUL projections.
Right.
IUL. If the stars align, this is what you're going to have. Well, I can tell you, when you look at the right side of our ledger, the stars aren't going to align. That's not going to occur. Could be better, could be worse. It's not going to happen, because there's a little piece of dividends, and I don't know where interest rates are going to go, and that's where we get our dividends from. But the key of what Scott said is, there is a safety aspect of what is projected. So when you're putting a plan in front of the client and you show that they can get out of debt in 9 years or less, without doing anything different, just redeploying their cash and using it smarter, differently, more effectively, you're only using 80% of what we're showing you on the guaranteed side. The guaranteed side, my 2 policies behind me, they are a contract. If you know the definition of contract, that's upholdable by law. My company can't change what I have. I know exactly, I can pick a year. Give me a year and I will tell you exactly how much cash value will have in my policies. The only thing that can change that is how I fund it. If I overfunded it, I'd have more. If I underfunded it, I'd have less. I control what's going to be in there. But if I pay according to what that contract states, that's going to be there. So we're basing it on, they're going to get out of debt in 9 years or less using 80% of what's actually available. If you stress the policy to the whole, did everything right, you want to keep the coverage in force, you don't want to lose it. But if you stressed it, you can knock that down to, I don't know, what would it, easily 8 years, probably faster than that. So simply 80% of what you have with an emergency fund at your disposal to cover your family's emergencies, real emergencies. It's the most powerful thing, and it's the statement that gets overlooked and not enough attention. This isn't a plan that's based on all the stars aligning. It's based on contractual guarantees. Your policy will grow while you use it, because you're not using your money, you're using mine. Not really mine, but you know what I mean. All right.
Covers the what ifs and the yeah buts. All those ones that you can't think of. We try to make our clients bulletproof as best we can, but this is something that really goes beyond. This covers the things you don't think of.
Yep.
Sorry, Mark. Keep going.
Oh no, the oxygen was getting high. It's pretty high up on this.
I wound Mark up, and I'm just letting him go.
No, that's all I got, Scott. I'm going to take a break.
Okay.
Who's
All
got
right.
questions?
Yeah, good afternoon.
Hey,
What
Rupert.
I'd like to find out, how are you? What if a wife and husband is interested in the program? Do you have both of them on the same program, or you do separate things with them? Yeah. There's a wife and a husband who's interested. Is it
Not
just
sure I
for one
understand your question, Rupert.
let's say there's a husband and a wife and they are interested in infinite banking program.
Okay.
Do you include both of them on the same program, or it has to be done separately?
Maybe. So for me, that's one of the things I do like about mutual trust is they allow you to write policies on husbands and wives at the same time and be on the same program. Some carriers allow it, most carriers don't, but this carrier does. And so you could put a husband and a wife on the same program as long as they're both insurable. But the other part of this is sometimes you want, and like this is one that we just did last week, the husband and the wife are both on it. They're both massive policies, like $850,000 each, right?
Right.
2 years, when they've max funded the primary policy, we're actually gonna split off the husband's term and turn that into another bank. And that's another one of the things that's really, I find, the unique about mutual trust, which is one of the reasons why I like mutual trust a lot. So does that answer your question,
Okay.
Rupert?
Yeah, definitely. Another question too. In term, the term, as I said, term, what I'm when the term expires? Because I noticed in their scenario, you have
Great
the whole
question.
life
It just depends on
paid
what
up on
you're
the term.
doing. So the term programs that you can get that are riders here are 10-year and 20-year terms, but it depends on the age of your client. You're not going to get a 20-year term rider on someone who's 69 years old. So it depends on the age of the client, really dictates what length of term you can get as far as a term rider is concerned. In general, it's going to be a 10 or a 20-year term, and it's going to be based on their expected longevity of what you can get for them.
Okay.
So I can tell you this, that and I've probably written 40 or 50 in the past 3 years where there's a husband and a wife on the same policy. In almost every case, there's a plan for the second policy, the second term to be converted, and it's usually somewhere in about 3 or 4 years. That's part of the plan. I can only think of one instance where we actually got the term rider for no other purpose other than to get coverage on, and that was one that we insured the wife as the primary. We did a small $100,000 term on the husband. There's a $110,000 term on the husband, and that was because we were using some of the money that he was spending on a really inefficient life insurance policy that he had with one of our competitors. So getting him the term rider, he had a 10-year term with another company that I won't name here, but they're very expensive. He had a 10-year term rider with them, and he was paying $200 a month on that 10-year term. And we put him on this, and the 10-year term here was only $58 a month. So that extra $150 is actually went right into cash growth of the program and helped eliminate their debt faster.
Okay. Perfect.
Does that help you?
Yeah, definitely.
All right. Anybody else got a question? Mark?
Can I talk about exit strategies for a minute?
Please go ahead.
All right. So you're putting a plan in place to help your clients get out of debt. They're going to do that. But then what's next? What about their retirement? Let me tell you, again, Scott alluded to an unfortunate year. What he was talking about was my mom passed away 2 months prior to my brother. And we're dealing with her estate while we were dealing with my brother being sick, almost simultaneously. Actually, absolutely simultaneously. My mom lived in a condo, paid for. Condo's sitting there. I look way younger than I really am. I don't. I'm 57. I'm starting to think about retirement. And one of the things in retirement is, what am I looking for? How am I? No, not yet. I got some years. I have a practice wife to pay for still. One of the things I'm looking for in retirement is residual income. Where can I get some money, right? What is everybody doing these days? Rental properties, right? Well, I started considering, I talked to my two brothers and my sister-in-law about the property, my mom's property, and what do they think? I gave them an opportunity to buy into the idea that I'm going to keep it. We're going to keep it. Somebody's keeping it in partnership or singularly. I talked to them, and for various reasons, they want to cash out. Um, so what I realize is I've got an ability, I've got a policy, I've got 2 policies that are healthy enough, and with a little bit of cash that got from some policies. That's a whole nother story. Oh, smart money. Did that for my mom. I can tell you how that benefited us and her another day. But from a death benefit payout from my mom, plus the cash I have in my policies, guess what I can do? I can buy out my family from the house. And now the condo is mine. And now we're going to rent it out. And I've got a residual stream of income based on my projections on what we can rent it out for. That policy loan will be paid in full from rents and still provide some residual income for me now. Small. I'm going to get aggressive. I want that policy loan gone as fast as possible. But by the time I plan on retiring, all that rent money is pure income to me.
Yep.
That's your escape plan. So this policy is good now, but what do you do with it later? Oh, it's going to create, I'm using it now to create income for me later. And oh, by the way, later in life, if I so need it, I can draw down those cash values. I can use my cash values in my policy in years where the market was bad and my 401k is hemorrhaging, and I really don't want to take money out of a qualified plan when the market's down 18%. It's bad. Where am I going to get my money to live on? My policy, because my policy doesn't care if the market's up or down. My policy is going to perform just like it's supposed to. So it's a better way. What about Social Security? Do I want to take Social Security now or 5 years? Do I want to defer as long as possible? If I defer, where's my income coming from? Guess where it's going to come from? It's going to come from my policy and some cash pockets I got. I'm going to have the means to increase, presuming it's still there. Let's have faith. Presuming that Social Security benefits still exist by the time I retire, I've got a way to get an increased benefit. All the different ways that whole life policy can serve me, even beyond getting me out of debt.
There's a point you just made, assuming Social Security is still there. What about if we assume it's not going to be there?
You better have a plan.
Then the plan is even more important, right? And they've already telegraphed that Social Security, the value of Social Security is going down, and they're increasing the retirement age another year. So we know that there's, they're decreasing the amount that they're paying out, and they're increasing the length of time you have to go before you can take it. So don't bet on it. Don't count on it. And certainly by the time that we're able to get it, the problem that we're seeing now is that, yeah, we've got modern medicine and we're theoretically living longer, but that's not the case. It's not really increasing our longevity yet. So, we're going to be making less money, and we're going to be having to go longer, work longer before we can actually get less money. So don't rely on it. And I love the idea of real estate. And this is something we just talked about on our show last week, where we talked about how the real estate market is becoming attractive to cash buyers, and is becoming offensive to mortgage buyers, because the mortgage rates have gone up so high. And so you're going to start seeing, and we're already seeing it, a degradation in values, home values. And where before we were definitely in a seller's market where, no, I'm not going to give any concessions. I want 20 or 30% beyond what I'm asking. That's what we were seeing in this time last year. Not anymore. It has changed. And now we're starting to see that the buyers are actually they're being able to demand some kind of concession from the sellers, and the sellers aren't getting what they're asking. Especially once you reach a certain level of pricing, which is greater than $300,000 on home prices, you're starting to see them come down. You're starting to see regular reductions in price. And then now you're starting to see, buyers agents are confirmed at 4%. And you're starting to see, we will offer $20,000 in seller concessions, to pay your closing fees. So it's coming full circle. And where the cash, if you're cash rich, it's going to be a buyer's market. And the kings and queens of the buyer's market are those with the gold, because they follow the golden rule. And the golden rule is the people with the gold make the rules, right? So that's where we're headed with that. So yes, I love real estate. It's a great option. It's going to be even better here the next year, probably a year from now, a year and a half from now, it's going to be even better option. But yeah, so don't get me on that soapbox. I did about 4 hours of research for that last show on just the real estate market and where that was headed and what's going on. So that was pretty cool. But yeah, all right. So thank you, Mark. Anybody else have any questions? Because Mark, I know you've been a real trooper here. I got one more thing I'm going to show people. We're probably going to shut this down early today. You may want to see this, Mark. This is
I'm sticking around.
okay. So if you guys don't have any other thing that you want to look at, let me go ahead and do this. Okay. So this is just a little tiny spreadsheet that I just did this morning. Because I have a client that I'm going through right now that's really having a difficult time getting his head wrapped around why it makes sense to do it this way using an infinite bank than just to pay cash to pay off the debt. You guys ready? So I am really, really bad with graphics, and my VA is on vacation this week. So I apologize for my pedestrian illustration here, but the numbers are real. So if I look at, I've got $4,000 cash, and I can deposit that into my savings account, or I can deposit that into my infinite bank, assuming my infinite bank is already started. So if I do it that way, then the average interest rate I'm getting on a new savings account is about 0.5%. You can go some places and get better numbers, but that really doesn't affect too much considering what happens with the money once you take it out of the savings account. So let's assume I put $4,000 in each program. I get my 0.5% interest with the savings account, and I get my 3% interest, which is guaranteed by contract, with my infinite bank. So at the end, I put in 4,000. One of them is going to make $20 in interest. The other one's going to make 120. Now with the savings account, I'm going to spend $3,500, and I'm going to go, remember that discussion earlier, the car? I'm going to go pay off my car. So I send that $3,500 to my car company, pay off that car. And now I have traded $3,500 for $3,500. I have a net zero gain. And I have $520 left in my savings account. Well, if I put it into my infinite bank, and I take a $3,500 loan from my infinite bank, then the balance of my infinite bank is still $4,120 because I earned that interest. I didn't take my money. I took a loan. And now I do owe loan interest. My loan interest is $166. Okay. So my loan interest is $166. And if I take that loan interest out of what my actual cash balance is, at the end of the year, I have $3,953 in my account. And I own that $3,500 of that car. So right off the bat, we're way ahead. On the left side of my equation, my value is 3,500 plus 520. On the right side of my equation, my balance value is 3,953 plus 3,500. Okay, do you guys get that? Following me? Year two, it gets even better. So year two, let's say in year two, I have another 4,000 I'm going to deposit. So I put the $4,000 in, and now my balance in my savings account in year two is 4,520. The interest rate that I earn on that is $22.60. So at the end of the year, I've got $4,542.60. If I did the same thing with my infinite bank, I put an additional $4,000 in, then my infinite bank balance is now $79.53.40. My interest on that is $238. And that interest is way more than I need to pay the interest on the loan. But we're still paying the loan. We haven't touched the amount that we owe on that $3,500 loan yet. So at the end of the year two, in my infinite bank, my bank value is $8,025.40. Okay. So I'm way better than what I've got in my savings account. But wait, I still got that $3,500, right? Because I still have the equity in that widget that I paid off. In year 3, this is where it really shines. In year 3, I dropped back and I only add $500. So now in year 3, my interest rate in my savings account is 25.21. I've got $5,067 of cash value in there. With the $3,500 value in the car, my net wealth is 85.67. Okay. And then in the private bank, I do the same thing. I add $500. My net wealth is $12,114. Which one's better? So this is all about creating wealth. Okay. And if I decide at that point, this is about choices too. If I decide that I don't want to keep that $3,500 loan on the books, I don't have to. I can take that 3rd-year interest and have it applied directly to my loan and pay my loan down every year, which is going to decrease my loan interest, which means that's going to create a snowball. It's going to snowball, pay off that loan faster, even if I don't add any extra money in. So folks, this is a hopefully clear illustration about what the real value of these programs is and why it makes a whole lot more sense to put money into a vehicle where you can borrow against it immediately and use the money over and over and over again, and have the vehicle that you're using help you pay off the loan that you took from yourself. Notice we didn't have anywhere contributed any kind of dividend here. We're not even counting the dividend. Okay. That this is a much better way than just putting your money in a savings account. And then the other thing that we hear, the other question we get is, but I'm not liquid. No, you are liquid. You absolutely are liquid. You're way more liquid than you are in your savings account. And then the last thing I'll say is this. I just had this discussion earlier today with a client. Have you ever heard of a bank that failed? Anybody hear of Silicon Valley Bank? Anybody hear of Credit Suisse, an international bank that failed this year, right? Anybody ever heard of an insurance company that failed? Anybody name one? Yeah, me neither. So when we talk about security, you know that your deposits are insured by FDIC when you're in your bank. And if you get $1 million of value and you put it into 4 banks, how much coverage do you have? 250,000. Not in each bank. It's total. Okay, well, you're putting it in an NCUA. Yep, 250,000. Not in each bank. Total. Right? What's your protection here? It's really unlimited, because you're talking about the good faith and ability for a company that's never failed, for an industry that's never failed, to be able to support what their contract they're putting out. Love that one, Mark. You can unmute. That's a good one to say. Yeah. Go ahead.
Mutual whole life carriers have never claimed a bank holiday. So through the crisis in 2008, the Great Depression, and anything else you can think of, our doors have always been open. Our clients have always had access to their policies.
Yep. And you've always had access to their money.
Mm-hmm.
So from a security perspective, this is hands down blows away any bank that you can put money in. All right, folks. This was supposed to be informational and show that new little tool that we just looked at for cash value. Anybody got any questions for us? Come on, Susan. Nice to see you, by the way. I haven't seen you in a while.
Yep, well, it's been busy. Thanks. It's great to see you. And Mark, it's a pleasure to speak with you, and our condolences to you. Double time, absolutely. I'm very happy to be able to say that I currently have a lovely policy with your company, for my family who want to open another one. Not immediately, it's going to take a little time, but from a second mortgage that we're paying off with the debt-free life program, that is probably going to convert into a sale of that property. So with that income, he wants to open up another policy. In the meantime, wants to open a few policies for grandkids and this and that. So it has just turned out of one level up lead that's just populating across the whole family. And they're so thankful for what we have been able to do to help them. And I thank you, Scott, for investing in me to teach me what I needed to ask to get the best answers for him so that we could match it up with the greatest product that's on the market. And we're very pleased with what we've been able to do for them. My question, after a very long prelogue here, is to inquire what might be the best solution to open that next one. Would it be similar to exactly what we might have in place now? Or, and it's sort of crystal ball gazing at this point, but the situation will be different in a year. But I don't have any reason to think that we'd have to do something else. We're going to, in time, need to reevaluate what we have in place currently. And to mimic what we currently have might be the best solution. I'm just wondering, as we're looking forward, and we always have in the DFL scenario, at this point, how many months later we'll need to reevaluate to keep this as an insurance policy and not an annuity, or not to create a mech. So in so doing, are there any tidbits of wisdom that you could provide to me at this point as we look forward and explain to the client what we do at that juncture? Sorry that was so long, but it was unrehearsed, and that's why.
No, and Susan, thank you for your business. I greatly appreciate it. All right, so there's not an easy answer to project here, and what I would encourage, and something I can plug, we are an extremely accessible company. We love partnering with you and discussing your cases. And so what I would invite is an offline discussion so we can talk through a little bit more of the client's unique situation. And when developing these plans, there is true flexibility. And the number one question I usually have when I'm working with agents is, tell me what they have, what's the objective, and what kind of cash flow are we expecting? What do we want to plan for? And we can create that plan that's flexible, that's going to meet all those guidelines. We keep the policy from ever becoming a MAC, and it will be it'll meet the needs that you're looking for. So I assure you there's an answer in there. It just requires a little more conversation between us just to get to the nuts and bolts. Yep, we can fund it very heavily up front and allow for minimal premium payments and even flexibility to that. If that's difficult, like we can position it.
Thank you.
Yep. And my only comment with that would be, you're helping the family out, and you're helping them get to where they want to be financially. So there are ways that you can streamline policies as you move forward in time. Just be cognizant of their expected income and any changes that would be expected in the income, and make sure that you plan for that. If there's an expectation there might be a lowering of the income, then put the policy lower and crank up the PUA component of it so that it's more cash efficient, and that we don't do this for commission. That's not our goal here. We do this for what's right for the client based on what their goals and what their projections are and where they want to be. So in that scenario, yeah, you're going to be shooting yourself in the foot for a commission, but that's not what this is about. And you're
Absolutely.
going to be for a client. Always
Totally
for
agree.
a client.
Thank you.
And proof is in the pudding right there, Susan, because of the work you did with the client the first time around. The one sale created how many? How many potential sales?
Absolutely. Absolutely.
Yep. That's big. That's huge. Congratulations, Susan.
Thank you.
Hey, I didn't do anything. I gave you a couple of pieces of shtick. You did the work. You did the study. You did the activity. So you don't owe me anything. I appreciate the kudos. That's not me. That's all you. Congratulations.
Thank you. Mark, your team is amazing. Every interaction I've had with the company has been resourceful, efficient, just so clear and concise. And there's been a lot of underwriting, no doubt. It's been a unique situation with my client and his family. But aside from that, the level of expertise and sharing of information has made it absolutely a joy to do. And for that, I'm forever thankful.
I appreciate it. We have an amazing team. I am blessed to be part of this group.
Nope. Thanks, Susan. Anybody else? Adele? You're still hanging out here. You got any questions? Oh, congratulations on your certification.
Thanks. I have the trifecta now.
There you go. That's what you've done, the annuity, the IUL, and the DFL cert, right? Right on.
Yeah.
Talk to Dally.
Oh,
Make sure he.
it was actually very helpful.
Okay, very good.
Helped me understand way better. So I'm glad that I finally finished. I'm sorry it took so long, but I made it. Woo. I'm ready.
Faith in you, Adele. All right.
Thank you.
Anybody else? Well, Mark, as always, thank you for supporting us. Thanks for supporting our agency and our organization. And we really appreciate you in especially with what's going on in your life. You're taking time out of your evening to come here and hang out with us on a Thursday night and just kind of pour into us. And I really appreciate you. So thank you very much. My best to your wife.
Thank you. And truly, Scott's heard this a million times, but he knows I mean it. We don't have anything to do if it's not for our clients and for you who bring them to us. And so every time you bring a client to us, we celebrate. And we are truly humbled for the opportunity to serve you and your clients. If you've heard from me before, you've heard me say that, and I truly mean it. And I'm grateful for the opportunity. And as long as Scott keeps having me on, I'll keep getting on my soapbox and preaching what a wonderful industry this is and how impactful it is to the families you serve, to the communities they live in, and for you and your family.
Hey,
So
Mark,
thank you.
Isn't there a new IUL coming out?
We do have an IUL. So we are a whole life company and we'll continue to be whole life, and we will continue to devote ourselves to great strategies like this. But we are coming out with an IUL, and unfortunately just got some news. Our state insurance departments aren't being very responsive. And so we're a little delayed on where we wanted to be. We thought it would be available in October. I think we're looking at November now. We need little things like the applications approved and stuff like that. Our work's done. But the IUL is going to be a cool little thing. It's going to perform like you would expect a good IUL to, but it's going to be a little streamlined. And here's the scary part. I'm dangerous. I've just about said everything I can about what this looks like. I am not on that project. But we can't wait to introduce it to you. And here's the cool thing. In the world, there is no such thing as a whole life client. There is no such thing as an IUL client only. You can't make them be something. It all depends on what they want. But what if there's a way they can be both? What if an IUL and a whole life produces the desired result for your client? Could you split the premium and give them some upside that the IUL provides, but yet give them the guarantees and instant liquidity that the whole life provides? Why, yes, you can. And what if those products were both offered by the same company, and with the sale of these applications came a ledger that combined the values into one neat little form that said, here you go, this is what your solution is going to look like? Would that be something that intrigues you?
So are you saying it's almost like a whole life with a partial performance of an IUL over time?
They are two different products, two different policies that will be issued, but you will get a blended solution that takes some upside and takes some guarantees, and you decide how much of what you want, and you create the solution for your client, and you'll have one little ledger page to show them, hey, combined values, instead of having two illustrations going, okay, this is what you got. It's going to be one page that says, hey, this is your blended solution. This is why we're doing what we're doing.
So let me ask you a quick question. So from an agent that tries to help families and earn money that way to support his family, does that mean that, like an IUL, like most IULs, there's probably a residual commission component to it?
There's a residual. Have we never talked about the residual commission component to a DFL plan?
Oh, well, we know about that. I talk about that all the time.
Yeah. Yes, one would assume so. Again, this is where I'm dangerous. I'm going to say yes, but don't hold me to it. Don't quote me.
Right.
This is not, that part was not recorded because I've said everything I know about the RIUL right now, but one would assume yes.
So
if it had it before.
Is there any projection on convertibility?
Yeah, don't have that yet. Stay tuned.
Okay.
Stay tuned. We'll keep teasing, and the moment I have information, I'm going to bring it to you.
Okay. I'm excited.
Me too.
So Lucas is really excited.
Yeah. We had to convert our boss to be a whole life guy because he came from the IUL world. And he
Which-
kept saying they and you.
They and you.
Yeah, they meaning us and you meaning
Is that Luke?
his
Or
old
Bruce?
yes.
Okay.
Luke, he came from North American. So
I love North America.
and our guy on the IUL project used to run an agency himself that promoted IUL very heavily. So he knows IUL market very well. So when he tells me this dog will hunt, this dog will hunt.
Right on. Well, we're excited. And that's going to be same kind of, I guess, similar underwriting to your term programs and fully underwritten, other than maybe an accelerated underwriting opportunity under the age of 50.
Sure. Yeah, we'll have some stuff like that. There
And
will be underwriting involved to some levels.
is
Hey,
there
what I can tell you, who made that? Susan made the comment about underwriting. In the background, we're working on some things to speed. I don't want to call it accelerated because it's not that. However, it's going to accelerate the process. Some back end stuff that's going to be that our underwriters are going to have accessible to them. That's going to speed up how long it takes them to get through different pieces of the process. It's going to speed up how quickly we identify what we need to complete the underwriting. And then the day two part of that is it's going to become apparent to you through the e-app. So it's going to be the e-app will become a little more intuitive that, hey, you check that. So boom, 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 give us this now. It's going to stop a little bit of back and forth. So these applications are going to get through faster and faster and faster. Underwriting is a necessary evil. Your client's becoming part of a club. We don't exist for the profits of stakeholders or stockholders. We exist for the safety and the protection of your clients. So what we're doing is making sure that all your clients that you protect, Susan, the family you put with us already, the next client you bring to us, we're protecting that original family to make sure that we're not taking a risk that jeopardizes what that first family has with us. The promise that we have that we are there now and forever for their financial needs.
all right,
So it's a necessary evil.
I know you don't have a whole lot of knowledge about this yet because you're not on that team, but I'm going to ask this question anyway. Is this an adult only IUL or is this an up to age after age 15 days IUL?
Why do I feel like I've heard this answer? I suspect if I were to take a stab at the answer, and I'm not 100% sure, I think it is adult.
Okay.
But we'll find out.
Okay.
Yeah, stay tuned.
All right. Because I know Lucas wants to take out one for his unborn child. Yes.
Congratulations.
Look, it's Hannah. All right. Well, Mark, again, thank you as always. Thanks everybody for showing up. Hopefully you got something out of this. We typically do these programs twice a month. Usually they're always after the radio show, on the Thursday after the radio show. And then there's usually one other Thursday. So stay tuned and we'll schedule the next one. I don't know when. I know we're getting ready to go on vacation. So it'll be sometime in mid to late September. But thanks everybody. Have a great week. Bye.
Thank you.